Welcome to vTalkInsight, Risk Sentiment Daily for December 3, 2025. Markets are walking a fine line today, with optimism around imminent Fed cuts and powerful AI growth stories pushing risk assets higher, even as deeper structural and credit risks quietly build beneath the surface. Across major assets, today's picture is best described as cautiously risk-on. Equity indices continue to find support from renewed expectations of near-term Fed easing and ongoing enthusiasm around artificial intelligence-driven growth. At the same time, the tone is far from euphoric. Under the surface, we see elevated volatility in key sectors like technology, risk-off behavior in crypto, and a heavy use of hedges that all signal investors are embracing upside with one hand and holding on to protection with the other. Compared with earlier this week, conviction around a rate cut has tightened rather than loosened, with implied probabilities rebounding from roughly 1 in 3 to almost fully priced. That shift has helped stabilize equities despite mixed macro data and rising loan end yields. Yet bond markets are sending a more cautious message. 10-year Treasury yields are edging higher even as recent economic readings, such as weak ISM figures, argue for slower growth, highlighting an unresolved tension between the policy easing narrative and term premium and fiscal concerns. Positioning and flows reinforce that this is not a straightforward risk-on environment. Money market fund balances have climbed to around $8 trillion, a record level that reflects a strong preference for cash and ultra-short duration strategies. Auctions activity has pivoted away from single names toward index and exchange-traded fund contracts, pointing to a more macro-oriented, hedge-heavy posture. And institutional investors are described as largely neutral and sidelined, with retail flows contributing disproportionately to recent swings. Overlaying this, concerns about stretched valuations in parts of tech, leverage building through margin debt, and renewed stress in digital assets all underscore how quickly sentiment could flip if the Fed disappoints or an AI-related risk event materializes. So the current equilibrium is one where liquidity and growth stories are sustaining a cautious bid for risk, but portfolios remain finely balanced between upside participation and downside protection, leaving markets highly sensitive to incremental news on policy, yields, and credit. Near-term Fed rate cut bets are once again at the center of the market narrative. Implied probabilities for a cut have surged back from around 30% to levels close to certainty, with some measures pointing to roughly a 95% chance of easing. Futures are also leaning toward multiple cuts over the coming year, signaling strong conviction that monetary policy is about to pivot from restrictive to supportive, even though incoming economic data since the last meeting have been limited and somewhat mixed. This pricing has been a key engine for renewed risk appetite. Expectations for a December move, now approaching 80% in some estimates, and the prospect of a full easing cycle are cited as drivers behind the latest equity strength and broader risk asset resilience. The logic is straightforward: lower policy rates would ease financing conditions, support valuations for duration-sensitive assets, and provide a buffer against softer growth, all of which markets are attempting to discount ahead of time. The risk for markets is that these near-term Fed rate cut bets have moved well ahead of what the central bank ultimately delivers. Several observers highlight that if the anticipated sequence of cuts fails to materialize, or if the Fed signals fewer moves than currently priced, risk assets could face abrupt downside volatility. That concern is reinforced by the behavior of longer-term yields, which remain elevated and are even drifting higher despite the easing narrative, suggesting that parts of the market are already questioning how aggressive or durable the forthcoming support will be. In this context, the upcoming Fed decision and communication become critical watchpoints for cross-asset positioning. Markets will be parsing not just the policy move itself, but the tone on labor market softness, the dispersion of views within the committee, and any pushback against the forward curve. For portfolios, the key takeaway is that a great deal of good news on rates is embedded in current pricing, while the path of long-dated yields and the Fed's messaging on future cuts will likely dictate whether the present cautious risk-on tone can extend or flips into a repricing episode. AI-led growth and earnings optimism remain a powerful bullish force. Major cloud and infrastructure providers are committing to aggressive expansion, with one hyperscaler planning to double data center capacity to 8 gigawatts by 2027 and to refresh its in-house AI chips on an annual cycle. Adoption of those AI-specific servers is already material, with more than half of certain AI workloads now running on in-house silicon, while demand for established GPU platforms continues to accelerate, according to management commentary from leading chipmakers. This investment surge is feeding directly into corporate results. A database and software company sharply raised its outlook, citing AI-powered applications as a key driver, and saw its share price jump over 20% on the day. Other technology firms are reporting strong growth in recurring revenue tied to security and AI-related services, even when some of the upside is helped by easier comparisons, underscoring how central the AI theme has become to earnings and index leadership. At the macro level, AI investment is already estimated to be contributing to United States economic growth at roughly 3 times its historical pace, and that elevated contribution is expected to persist. Forecasts of between $5 and $7 trillion of AI-driven data center and infrastructure spending over the next 5 to 7 years highlight the scale of the potential demand shock. For risk assets, this supports a narrative of stronger trend growth and durable earnings power, particularly in U.S. equities, which helps justify higher multiples and continues to attract capital into AI beneficiaries. That said, there are clear challenges to this bullish driver. Several observers note that projected AI infrastructure spending of up to $1 trillion by decade's end is not yet supported by underlying cash flows, raising sustainability questions and echoing past overinvestment cycles. Valuations across AI-exposed names are already elevated, and rising competition from both U.S. rivals and rapidly advancing Chinese firms could trigger sharp repricing if growth expectations are missed. The combination of high leverage, circular financing structures, and private credit exposure to AI projects means that any disappointment could transmit quickly from equity to credit markets. Liquidity and fiscal expansion tailwinds are another important pillar behind the current risk-on tone. Market liquidity is described as improving as quantitative tightening winds down and renewed treasury spending injects cash back into the system. This combination has been supportive for both equities and, at times, crypto markets, helping offset pockets of volatility and providing a cushion against idiosyncratic shocks. On the fiscal side, the Invest America Act points to a new, long-dated source of equity demand. The plan would fund $1,000 investment accounts for every newborn between 2025 and 2028, with the capital directed into broad index funds primarily tracking the S&P 500. Large corporations and philanthropists are expected to match or supplement these contributions, and the program enjoys bipartisan backing, suggesting the potential for meaningful, politically durable inflows that broaden household equity ownership over time. In Europe, rising defense commitments add another layer of fiscal support. Germany is moving ahead with billions of euros in new procurement, while the European Union is allocating substantial funds to secure raw materials for critical technologies and defense, both of which underpin industrial activity. Taken together, these liquidity and fiscal dynamics help sustain demand for risk assets even as investors grapple with higher yields and cyclical uncertainty, though they also intersect with concerns about deficits and term premia that we will come back to. Balancing the upbeat AI story is a growing focus on AI and private credit fragilities. Market participants are increasingly worried about the opacity and leverage in private credit, where banks often have indirect exposures through lending facilities and collateralized loan obligations. Regulators are responding. The Bank of England is launching a new stress test of private credit markets, even though these assets sit largely outside its direct remit, underscoring the perception that this has become a potential systemic pressure point. A significant share of private credit appears tied to AI-related investments, from data centers to specialized hardware and software. Many of these projects are funded with debt on the assumption of strong future cash flows, but some analysts question whether the returns will ultimately justify the scale of the capital being deployed. That uncertainty raises the risk that, if AI revenues fail to meet expectations, the stress will first surface in private credit structures, where transparency is lower and liquidity can be limited in periods of market strain. Concerns extend beyond credit into broader bubble dynamics. There are reports of circular financing, where AI companies invest back into their own investors, amplifying growth on the way up but potentially magnifying losses on the way down. Combined with already high equity valuations in AI-exposed names and headline figures such as multi-trillion-dollar infrastructure plans, this raises the possibility of a so-called AI bubblelet, where a sentiment break could trigger both spread widening in credit and a broader equity correction. To be clear, current broad-based distress is not yet evident. Default rates in high-yield and loan markets have eased back toward roughly 2.5% to 3%, suggesting a shift toward more idiosyncratic or secular stress rather than an outright cyclical bust. Credit markets are entering a phase of greater dispersion, where differentiation between stronger and weaker issuers becomes more important. For risk sentiment, the key issue is that AI and private credit have become identified as potential weak links, and any cracks there could quickly reshape the broader appetite for risk. Rising yields and fiscal concerns form a second major bearish counterweight to the risk-on narrative. Even as markets price near certain Fed cuts, 10-year Treasury yields remain elevated, recently quoted around 4.1%, and are trending higher after recent sell-offs. Short-term yields have edged lower on policy expectations, but the long end has firmed, leading to a modest steepening that reflects worries about term premium, supply, and inflation persistence rather than confidence in an imminent easing cycle. This rate behavior looks particularly striking against the backdrop of softer data. Recent United States ISM readings have been notably weak, which would typically support lower long-dated yields, yet the market has moved in the opposite direction. Some observers attribute the bond sell-off to thin trading volumes and year-end positioning, warning that price action may exaggerate the macro message, but the direction of travel still complicates the supportive story from Fed cut expectations. Fiscal dynamics add to the upward pressure narrative. Legal challenges to past tariff policies, including cases that could ultimately require the government to refund previously collected duties, would necessitate additional Treasury issuance if the rulings go against the state. Analysts note that such outcomes could steepen the yield curve, especially at the long end, by increasing expected bond supply. At the same time, new spending initiatives, whether for defense or investment accounts, feed into broader concerns about deficit trajectories. Higher and more volatile long-end yields pose several challenges to risk sentiment. They weigh on valuations for duration-sensitive equities and real assets, raise funding costs across credit markets, and have coincided recently with breakdowns in traditional hedges such as gold. One mitigating factor is that fixed income now offers more attractive nominal and real yields, which some investors view as a buffer against equity volatility. Even so, the interplay between policy easing hopes and persistent term premium is likely to remain a key driver of cross-asset performance. Defensive positioning and speculative asset stress round out the bearish side of the ledger. Money market fund assets have climbed to a record $8 trillion, signaling that a large share of capital remains parked in cash and ultra-short instruments despite the equity rally. At the same time, many investors view fixed income as increasingly attractive for both nominal and inflation-adjusted yields, not just as a return source but also as a potential stabilizer if risk assets correct on shifting Fed expectations. Hedging behavior also points to caution. Options flows have rotated away from single stock speculation toward index and exchange-traded fund hedges, reflecting a pronounced macro focus and appetite for broad downside protection. Recent equity advances have featured weak breadth, with only a handful of S&P 500 sectors posting gains while most constituents declined, underscoring how gains are concentrated and how vulnerable the tape could be to sector-specific shocks, particularly in tech. Leverage and crypto markets are where that vulnerability is most visible. Margin loan growth has accelerated to around 35% year-over-year, surpassing the pace seen when rates were near zero, which raises the risk of forced liquidations if volatility spikes. Crypto sentiment is already deeply risk-off, with sharp declines in Bitcoin and related exchange-traded funds, widespread auto-liquidations, and a fear and greed index firmly in the fear zone. Digital asset treasury companies act as volatility multipliers, potentially being forced to sell holdings as their own equity prices fall. There are, however, signs of structural acceptance of digital assets even in this difficult tape. A major United States bank is preparing to include modest crypto allocations in select client frameworks. A leading asset manager is opening its platform to a broader range of crypto exchange-traded funds, and regulators are working on innovation exemptions to support the sector. Still, with institutional investors largely neutral, retail investors driving much of the activity, and volatility in tech and crypto elevated, the overriding message is one of fragile risk appetite, where positioning and leverage could amplify any adverse shock despite the supportive backdrop from policy and growth themes. To sum up, today's cross-asset backdrop is cautiously risk-on. Near-term Fed rate cut bets, powerful AI-led growth and earnings stories, and supportive liquidity and fiscal trends are all helping to underpin risk appetite. Offsetting that, markets are grappling with AI and private credit fragilities, rising loan-end yields and fiscal worries, and clear signs of defensive positioning and stress in speculative assets from tech to crypto. The balance of these forces suggests that sentiment can turn quickly as new information arrives on policy, credit, and growth. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.